They said the market was doomed to flounder after one dramatic April crash. They claimed investor confidence would be shattered for the rest of the year. Yet here we stand, teetering on the brink of a new record high, defying every grim prophecy hurled our way. So what exactly happened between that painful plunge and this dazzling revival? And more importantly, what does it all mean for anyone scouring the horizon for the next big move? That, dear viewers, is the burning question of the day. Welcome to our deep dive into how the stock market bounced back from a period of intense gloom and doom. We will uncover how an initially terrifying wave of tariffs, talk of inflation, and widespread investor angst found itself replaced, almost overnight in market terms, by surprising optimism, skyrocketing technology stocks, and fresh hopes for more accommodative monetary policy. In this episode, prepare to discover the hidden forces behind this dramatic rebound, the key catalysts that set the stage for a potential record-shattering milestone, and the lingering concerns that could still derail the markets if we dare to get too comfortable. In the next several minutes, we will carefully walk you through three major pillars of this fantastic turnaround. First, how easing concerns around President Donald Trump's on-again, off-again tariffs soothed anxious traders worldwide. Second, the surprising and powerful role that technology stocks, led by the so-called Magnificent Seven, have played in this line-to-the-sky climb. And third, the signs emanating from the Federal Reserve that promise more interest rate cuts in the months to come. We will also examine precisely why the S&P 500, a crucial barometer of market sentiment, is nearing a brand new peak, just a few short months after it seemed all but buried under the immense weight of global uncertainty. Plus, we will sprinkle in real quotes and observations from financial insiders, the very people whose job it is to watch, gauge, and interpret the market's every twist and turn. By the end of this exploration, you will not only have a better sense of where we might be headed next, but also a broader understanding of how psychology, policy, and technology converge to push markets in ways that can occasionally feel downright surreal. Let us take a trip back to the beginning. Picture early April of this year. Tensions were at a breaking point. President Donald Trump and his administration unleashed a flurry of tariffs on so-called Liberation Day, a provocative move that left both businesses and world leaders scrambling to figure out the potential repercussions. Equity markets responded in the only way they know how when confronted with sudden turmoil. They plummeted. Talk of a collapse in global trade grew louder by the hour. Dismayed investors, eyeing their rapidly shrinking portfolios, waited anxiously for good news that never seemed to arrive. But then, as so often happens in the stock market's forever churning emotional roller coaster, circumstances began shifting. The S&P 500, the wide-reaching index that tracks the performance of 500 large companies in the United States, discovered a new sense of calm just days after President Trump's announcements. Remarkably, after bottoming out around April 8th, the S&P 500 soon started climbing. Within days, you could feel the tension gradually lifting. Daily volumes ticked up, liquidity improved, and there was a noticeable reduction in panic selling. Now, here is where things get really fascinating. By Thursday night, the index had jumped an astounding 23% compared to its 2025 low on April 8th. That means it rose from somewhere near the 2025 mark to as high as 6,141 in just a matter of weeks. The index closed that Thursday up 9 points, or 0.8%, inching tantalizingly close to its all-time high of 6,144 set back in February 19. This nearly impossible climb happened so quickly that even hardened Wall Street veterans found themselves casually referring to the move as almost miraculous. But that is not all. Step aside for a second and feast your eyes on the technology-heavy Nasdaq, which also flirted with its previous record of 20,174, a historic high from December 2024. On that same fateful Thursday, the Nasdaq rose 195 points, equivalent to roughly 1%, to close at 20,167, just 7 points shy of its own record. Financial analysts all over the street were left asking, is the market about to blow past its prior peaks any day now? Indeed, many watchers speculated that if the current trend held even through one or two more trading sessions, we would see a brand new record in both the S&P 500 and the Nasdaq. So, how in the world did we get here? Let us unravel the reasons one by one, beginning with trade policies. The conversation around tariffs started out explosively, with the president calling for reciprocal tariffs to correct perceived imbalances. This provocative approach triggered a wave of retaliations and chaotic back-and-forth negotiations. But after that initial noise peaked in volume, the real policy shifts seemingly entered a quieter, behind-the-scenes phase. Eager to stave off a catastrophic trade war, officials in Washington hammered out at least a short-term truce with China, providing the markets with a measure of relief. One of our key commentators for the day, Mark Lucchini from Janney Montgomery Scott, points out that once the immediate disruption calmed, investors quickly regained confidence. In his words, "We have gone into a period where we have not had a lot of disruptive noise coming either out of Washington or among our trading partners that has helped cool anxieties, at least for the time being." In simpler terms, the phone stopped ringing off the hook with new threats, new tariffs, and new disruptions. This calm environment gave the stock market precisely what it needed, a chance to breathe and to refocus on fundamentals such as corporate earnings, revenue growth, and product strategies rather than looming policy decisions. But keep your eyes open, because there is another pivotal date on the horizon. July 9, when the president's 90-day pause on reciprocal tariffs is set to expire. That means the trade drama could roar back at any moment, potentially puncturing the mood of optimism that has everyone from day traders to major hedge funds feeling remarkably bullish. Will the White House reiterate its stance on tariffs, or will we see further attempts at negotiation? If the White House extends the pause or negotiates new deals, we might see yet another wave of upward movement. If not, we could witness abrupt pullbacks, an outcome that would certainly keep every market participant on their toes. Before I guide you deeper into those uncertainties, I will take a brief break in this captivating revelation of market intrigue to deliver a small request. If you are enjoying this breakdown so far, consider showing a bit of support for our deep dive approach by tapping that like button. It might seem like a small action, but it inspires us to keep bringing you more in-depth looks at the stories that matter most. I promise we still have a mountain of gripping information to share, so stay tuned. Now, let us shift gears and talk about technology, arguably the engine powering this entire rally. The so-called Magnificent Seven, an unofficial reference to major technology companies that dominate headlines and often overshadow everything else, includes well-known giants such as Nvidia, Apple, and Amazon. In just about every conversation about the modern marketplace, you will hear that tech stocks carry enough weight to single-handedly influence the direction of major indices. Why? Because technology has become indispensable to every sector: retail, manufacturing, healthcare, finance, you name it. Whether it is cloud computing, artificial intelligence, or advanced data analytics, tech is the invisible backbone of contemporary business operations. The second quarter of this year, spanning from April through June, has seen technology become the best-performing sector in the entire stock market. This surge has occurred despite early concerns that a trade war and inflationary pressures might drive manufacturers to scale back projects or push consumers to limit big-ticket purchases such as new smartphones or laptops. Surprisingly, the appetite for advanced services and upcoming product releases has shown few signs of waning. Investors remain enthralled by the potential for transformative technologies, everything from expansions of artificial intelligence to the continuing ascendancy of e-commerce solutions. Take Nvidia, for instance. This chipmaker, widely revered for its prowess in powering everything from gaming systems to data centers, soared an astonishing 62% since the S&P 500's 2025 bottom on April 8th. On that Thursday in question, Nvidia ended the session on a brand new record high and reclaimed its lofty status as the world's most valuable company, based on market cap at that moment. By focusing relentlessly on semiconductors attuned to the needs of artificial intelligence, data analytics, and high-performance computing, Nvidia has convinced investors that it remains well-positioned to grow even when broader economic conditions start to wobble. We also saw a swirl of excitement around Micron Technology after it reported better-than-expected earnings for the latest quarter, a signal that the appetite for memory and data storage solutions remains robust. Adam Crisafulli of Vital Knowledge noted that demand for these high-end chip technologies seems to transcend short-term disruptions, indicating that enterprise clients, in particular, continue building out large-scale data architectures. Moreover, as remote work, telemedicine, and online education maintain their roles in daily life, the reliance on advanced computing hardware only grows stronger, a trend that bodes well for countless tech names in this subsector. Mark Lucchini, who has been watching these developments closely, says that investors gravitate toward technology because of high free cash flow and solid earnings potential. Companies such as Nvidia and other major players in the chip or AI space consistently demonstrate robust financial health, giving investors a sense of security that defies broader market volatility. Essentially, if you are looking for somewhere to ride out inflationary or tariff-driven storms, big tech can look like a fairly safe harbor, provided that you understand the inherent risks and historically inflated valuations. Then, of course, there is the financial sector, also receiving its share of the spotlight. While not as headline-grabbing as technology, many banks, insurance providers, and other financial services outfits are seeing impressive gains as well, buoyed by strong consumer spending and steady liquidity in capital markets. Brett Kenwell, an investment analyst at eToro, notes that these two sectors combined, technology and financials, account for more than 40% of the entire S&P 500. So, if these twin engines remain robust, the broader index almost naturally benefits. Now, let us not forget the Federal Reserve's role in this unfolding drama. If the trade detente offered short-term relief, the lingering prospect of interest rate cuts has investors feeling a whole new wave of optimism. The Fed had its June meeting recently, choosing to hold rates steady, but hinting at 2 potential cuts before the end of the year. Observers predict that a cut could come as early as late July, during the Fed's July 29th and 30th meeting, although most watchers believe September might be the more likely timeframe. Whenever the Fed moves toward a more accommodative policy, it often acts like a shot of adrenaline to the stock market. Access to cheaper capital can boost corporate earnings, encourage new investments, and, more generally, put wind in the sails of risk-on sentiment. Lucchini mentions that this scenario adds even more impetus for the market's dramatic recovery. If investors start operating under the assumption that borrowing costs will be lower going forward, they tend to spend more aggressively on both company shares and new business ventures, and that, in turn, pushes stock prices higher. The synergy between these different forces, temporary tariff reprieves, strong tech stocks, and the promise of cheaper money, helps explain why we have witnessed a near-total reversal of the doomsday talk from April. Let us not forget, though, that every silver lining has its potential cloud. All it might take is one unpredictable tweet or a fresh wave of tariff announcements to knock the wind out of the market's sails. Federal Reserve Chair Jerome Powell himself has cautioned that if the reciprocal tariffs do come crashing onto the scene in full force after July 9, the resultant inflationary pressures could stifle economic growth and hamper consumer confidence. The mere anticipation of that possibility might generate significant volatility in the months to come. If tariff tension spikes in the thick of the third quarter, the robust data from the second quarter could fade into memory. Some economists have already predicted that the real brunt of the tariffs is poised to strike the markets in the latter half of the year, pushing up prices on a wide array of imported raw materials and goods. That scenario would mean a spike in inflation, a dip in corporate profit margins, and potentially a significant slowdown in the overall economy. The Wells Fargo Investment Institute, for one, released an analysis highlighting how the United States could end up burdened with some historically high and potentially debilitating levies should the negotiations fail to reach a harmonious resolution. Yet, and this cannot be emphasized enough, Wall Street seems to harbor a rather staggering capacity for shrugging off doomsday scenarios when the immediate data suggests constructive trends. In other words, even if a downturn seems likely to arrive down the road, many traders are far more concerned about next week's or next month's gains. As Brett Kenwell from eToro observed, we hear all these narratives of what could go wrong, or what is going wrong, but the market does not seem to care. That curious mixture of short-term optimism and longer-term anxiety characterizes the current environment. On the one hand, smaller retail investors see the S&P 500 flirting with 6,144, the Nasdaq inching toward 20,174, and wonder if they should jump in now or wait before increasing their exposure. Meanwhile, large institutional players parse every new data release, from official inflation numbers to corporate announcements, determined to time the market's next pivot. An impossibility, some would argue, but that does not stop them from trying. So, what lies ahead for both the big fish and the everyday investor? If the White House extends the trade pause or the negotiations during the next few weeks bring about a more permanent deal, the euphoria might well continue. The technology sector might dig deeper into AI developments, attracting massive amounts of capital in the process. Financial companies could see a thriving economy stimulate additional loans, mergers, acquisitions, and expansions, fueling still higher valuations. August might witness a wave of fresh announcements at large industry conferences, be they semiconductors, consumer electronics, or financial technology, and that could catapult certain segments of the market higher still. Simultaneously, if the Federal Reserve performs 1 or 2 rate cuts, short-term interest rates will sink, providing even more reasons for companies to borrow and invest. Allow me to drop a second friendly reminder to take just a moment and subscribe if you are finding all these insights valuable. Think of it as your backstage pass to the swirling world of finance. By subscribing, you ensure you will not miss our next deep dive, where we will continue unpacking the most astounding market stories, analyzing unexpected twists, and offering clarity in a world that can occasionally feel too fast-paced to follow. Your support means the world to us, and we are always eager to bring you the fascinating angles that might otherwise slip under the radar. In the meantime, the third quarter is just around the corner, and with it comes a host of earnings releases. Analysts will pore over each line of revenue and guidance, searching for any sign that the current euphoria might be running on a shaky foundation. If large multinational companies begin citing trade disruptions or difficulty sourcing materials at competitive prices, expect it to show up in the form of lowered earnings guidance. That could produce a wave of stock downgrades and a subsequent pullback in the broader indices, a phenomenon that has repeated countless times in market history. Then there is the matter of consumer sentiment. Even the biggest tech companies rely on consumer spending, be it on new gadgets, digital subscriptions, or e-commerce purchases. If tariffs translate into higher prices that ultimately hurt consumer pocketbooks, you can bet the market will take notice. A slowdown in consumer spending would likely compress the growth outlook for everyone, from retailers to digital service providers, making it more challenging for the S&P 500 to sustain its upward momentum. However, none of these potential speed bumps have yet materialized in a decisive way. Instead, we are witnessing an almost storybook rally, with the indexes rebounding to near-record territory in record time. The near future might see a sizzling bull run, with certain watchers predicting that technology will remain the shining star, particularly in areas focusing on AI and advanced analytics. We should also keep in mind that banks and insurance companies, especially after robust second quarter data, might experience an even sharper bump should interest rates recede later this year. Throughout all of this, the biggest takeaway is that the stock market is seldom driven by a single storyline. Each day, countless data points, press releases, and headlines swirl together. We, as observers, form a narrative from the swirl of details, praising the bullish run or fearing the next collapse. Right now, we might lean bullish, but caution is never entirely absent. As always, the real winners will likely be those who maintain discipline, evaluate fundamentals diligently, and pay attention to the signals emanating from Washington, D.C. and the Federal Reserve. Will we see a new record high tomorrow? Perhaps. If trade tensions remain subdued, the S&P 500 might blow past 6,144, while the Nasdaq targets that elusive 20,174 barrier. Or maybe we will see a mild retreat before the next Fed announcement. The only thing guaranteed is more change, at times coming faster than we can imagine. That is the stock market in a nutshell. Perpetual motion, shaped by everything from corporate earnings to the delicate dance of global politics. This is why folks call it thrilling, baffling, and occasionally maddening. With so many moving parts in the modern financial ecosystem, the story rarely follows a straight line. One day, we are bracing for an economic storm. The next, we are celebrating a rocket-fueled rebound. That roller coaster is what captivates so many, ensuring that whether you are a brand new investor or a seasoned expert, there is always something mesmerizing around the next corner. As we begin our closing segment, remember the triple superstars of this current tale: the quieting of trade tensions, the relentless rise of technology giants, and the Federal Reserve's hints of lower interest rates. Each factor plays a distinct role, and each can shift in real time. Prepare for the unexpected. Keep your eyes peeled for that July 9 deadline. Remain vigilant around any additional White House announcements, and pay close attention to the Fed's timeline for potential rate cuts. If the Fed acts, it could either accelerate this rally or cause sudden confusion if the cut does not meet the market's lofty expectations. For all of you enthralled by these mesmerizing movements, be cautious but also stay informed. After all, knowledge and perspective are your best allies when navigating times that are as potentially rewarding as they are uncertain. The next few months could be absolutely pivotal in shaping how the rest of the year pans out, financially speaking. Is the market unstoppable, or is there a hidden pitfall lurking just around the bend? We will find out soon enough, as the fireworks continue, in what is shaping up to be one of the most fascinating chapters in modern market history. Nothing is more certain than the sheer unpredictability of modern finance. Nevertheless, we can find comfort and wisdom in staying plugged in, reading widely, and never letting fleeting headlines fully dictate our strategies. The path to long-term success includes careful, well-researched decision-making, no matter the exuberance or panic swirling around on a daily basis. When we see unstoppable climbs like this, it is always tempting to declare a new normal. Yet, history teaches us that markets ebb and flow, and that momentary triumphs can vanish under unexpected developments. Thus, as you keep an eye on the market tickers, remember that behind every surge or dip lies a set of interwoven narratives: global trade policies, cutting-edge technology breakthroughs, and central bank decisions. Stay curious about them all, because knowledge is one of the best counterweights against the anxieties that can strike both novices and experienced traders alike. Whether we scale new heights next week or find ourselves grappling with abrupt reversals, a well-rounded understanding of these key factors can help you maintain perspective. Finance is not merely about numbers on a screen. It is a grand stage where evolving politics, corporate innovation, and human psychology converge. And in that sense, the prospect of a brand new S&P 500 record, so soon after April's meltdown, reaffirms that the market has a knack for springing surprises when the doom and gloom narrative seems unstoppable. We will keep paying attention to how tariffs and negotiations unfold, how tech stocks redefine our concept of value, and how the Federal Reserve wields its power to influence borrowing rates. All told, it might be wise to hold on tight and be ready for the next act of this enthralling production, because the market has proven once again it thrives on big questions and bigger twists. Will the rally keep soaring to unimaginable peaks? Could the escalation of trade disputes slam the brakes on this remarkable run? Does the Fed have enough ammo to keep the economy stable if inflation roars back? The short answer: watch what happens. The only surety is that the next few weeks will be filled with intrigue and possibility. So, keep your seatbelts fastened. Until the next update, keep asking questions and remain vigilant for those signals that can make or break your strategy in the blink of an eye. Thanks for joining this extended examination of how and why the market overcame a sudden April meltdown, marched right back to record territory, and what the near future may hold. We hope this exploration has armed you with insights to better understand the big picture. As the roller coaster continues, we will be here to help you make sense of every thrilling twist and turn. Stay tuned, and best of luck in all your market endeavors.